How do we make money from gold? Well, there's a couple ways. You could buy the physical gold, or gold bars like some villain from a movie. You could buy GLD, which is an ETF that tracks the price of gold. And then lastly, there's gold miners. And in this video, we're talking about gold mining stock, KL, or Kirkland Lake Gold. And I did a little bit of research into the company, and I think it's undervalued. When I did the research, it was around $38.50, and so I thought there was around 30% upside. In this video, we're going to be talking about the details behind that and some of the assumptions that I was using. The reason I'm buying gold miners versus gold is because I'm similar in my thought process as Warren Buffett, where I don't love gold just because it's not a cash flowing asset. Whereas a gold miner is able to have reserves of gold, dig them out of the earth, and then sell them for whatever price gold is going for and make a profit. So they're able to generate cash flow from this prospecting, mining, and then selling the gold for overall profit. And you can see Kirkland Lake has a pretty hefty margin at 51% operating margin and a 30% profit margin. The company operates three major mines, one being Detour Lake in Ontario, Canada. They have one in Fosterville, Australia. And then they have Macassa, which is another Canada mine. Or Macassa, I have no idea how to say it. Help me out, Canadians. We don't have Q2 results yet, as that comes out later in July, but looking at Q1, we can get some reference points to their cost and how the company's doing. So Q1 was pretty solid as they beat the overall production in terms of gold output, and their AISC cost was $846 per ounce. And that abbreviation stands for all-in sustaining costs, and it's used across the gold mining industry to show how much it actually costs to extract that unit of ore. And since in Q1 they were able to sell that gold for around $17.88 per ounce, they were generating pretty hefty cash flows. And they were able to pay out a dividend as well as start to buy back shares. And the company also has a decent amount of cash on the balance sheet, to the tune of around $792 million just sitting there. And you may be asking, how much debt? Well, they only have $19 million in long-term debt. So we definitely have some pros and high margins as well as a strong balance sheet. The question is, are the costs in the future sustainable, as well as what are the production numbers looking like in the future? In regards to cost, we can look at their biggest mine in terms of production, as well as a 22-year production life. And we see through 2025, the cost of this mine is actually going down, which is great to see. It's currently in the thousands, and by 2025, they expect to get AISC down to around 726. And Fosterville in Q1 was around 423, and Macassa was around 947. In regards to production, we got a report out today with Q2 production results, and they are expected to hit their 2021 full year production of around 1.3 to 1.4 million ounces. We can use that for our revenue estimates when it comes to our discounted cash flow model. Some key assumptions is that the production is 1.35 million, and I use a price of around 1,800 in terms of sales price. And that has a large impact on the company, as the change in the gold price will affect their margins as well as overall profitability. And you can definitely see the correlation between gold price and the stock price of KL, as look at the chart of gold and look at the chart of KL, and you can see the similarity. Another assumption I had was in 2023 an increase in production for the Macassa mine, and in 2025 an increase in their production for their Detour Lake mine. I also used a 6.62% assumption in terms of growth for the gold price based on the last 30 years and kind of what gold has done. And all of this model basically spits out a number of $50.79 per share as the intrinsic value, using a similar percentage of revenue for depreciation as well as CapEx as a percentage of revenue, and using a similar tax percentage as previous years. KL also seems to be cheap relative to their competitors in terms of price appreciation versus similar companies, as well as the valuation multiple of EV to EBITDA. They are trading at more of a discount at 5.92 versus their peers, all the while having one of the highest ROEs for the group, as well as the highest profit margins, and has one of the best price to book values. In terms of risk, I see the biggest risk in the pricing of gold because of the correlation between the value of the stock and the price of gold. If tomorrow the price of gold crashed to $1,500 per ounce, that would obviously be terrible news for this stock. On the other end, if it went to 2,000, that would be great. So it's kind of a double-edged sword. And then of course you have the operational risks when it comes to gold miners. So that project that's supposed to bring on 200,000 ounces of gold each year in my casa. If this gets delayed for whatever reason, that could also impact the future revenue. Some people also see gold as an inflation hedge. For me, I see it as more of an uncorrelated asset to put in the portfolio, and I would rather have a gold miner that is cash flowing and has a valuation and is able to extract even more value from gold versus just holding onto gold. But if you are one to believe that gold is a good inflation hedge and you saw that June number of 5.4% increase year over year, well, this is one way to play into that gold hedge. If you did enjoy the video, make sure to give it a thumbs up and subscribe to Main Street Wolf so you don't miss the next time I'm talking stocks if you enjoyed this video. Thanks guys for watching and have a great day.